In the year 2000, in US dollar terms, gold was at $253 an ounce. Gold has generated, in US dollar terms, over an 8% compound return for 25 years. People, I think, had expectations around gold that stemmed from them not understanding the role of gold, which is to protect your purchasing power. Yes, the movements have been more outstanding in 2023 and 2024 for reasons I suspect that you put your finger on, which is to say central bank buying. The central bank buying has been building for 10 years, but I think the U.S. confiscation of Russian assets in the United States and the attempts by the United States government to weaponize the SWIFT banking system and the eurodollar market has meant that non-U.S. central banks concerned about the internationalization of U.S. policy have had no choice but to buy gold. They want a store of value and a medium of exchange that can't be manipulated by the U.S. government. And the great unspoken secret is that they don't trust each other. And that neutral store of value and medium of exchange has been gold. As you suggest, too, the strength in gold has really been due to central bank buying as opposed to retail buying, with the exception of retail buying in China. But if you examine, as an example, in either the United States or Europe, retail participation in gold-oriented ETFs, what you see over the 5-year time frame is 7 or 8 months of positive inflows to gold by the retail, and the rest of the time, over 50 months, flat or negative flows. So we really haven't seen retail participation in the gold market. By the way, when people ask about the difference in performance between gold and the gold stocks, I suspect that central bank buying explains most of it. The central banks have been buying gold, but they don't buy gold shares. The consequence of that is that although the assets are related, it makes perfect sense that the asset class that has determined buyers would do well, and the other asset class would suffer a malaise, which is precisely what's happened.
Mm-hmm. And from my understanding, we have had the same situation, or kind of the same situation, in the 70s, right? In the 1970s, we had a huge inflation going on. We then had the gold price picking up and the gold stocks were still lagging behind. But a couple of years later, the gold stocks in particular had a tremendous rally, to be honest. And I am young enough to remember, but Rick, as you just outlined a couple of minutes before, you have been there in this time. Can you tell us a little bit more? Do you see similarities now?
I came of age as an investor in the 1970s, and that was an interesting set of circumstances. Even before I had the capital to invest, I was interested in investing, so I was a student. And I remember in the period 1968 to 1972, certainly in the United States, the specter of inflation was in front of us. And the disaffection, particularly in Europe, with the US dollar as a medium of exchange was also present. When President Nixon suspended convertibility of US dollars for foreign holders into gold, that was a warning note for Europe, particularly for France. But we had been through, at least in North America, such a benevolent economic climate that, in the post-World War II period, 1946 to 1968, that people were trained, as they are now, to buy the dips. And despite the fact that we had a real equities market malaise, and despite the fact that inflation was evident, nobody really paid attention to inflation in the period 1968 to 1972. By 1972 or 1973, pricing levels in the United States were up substantially, but wages hadn't kept pace. In other words, inflation began to have a meaningful impact on people's standards of living. And suddenly, people caught that. There was a political response, too, so that in late 1974, the Fed began to raise the interest rate to temper inflationary expectations and also constrain the growth in the money supply, which was inflating asset prices. When the interest rate rose, the US dollar strengthened perceptively, but the real estate market, the equities market, and in particular the bond market, got crushed. When the US government and hence the US Fed lost their resolve and capitulated at the end of 1975 and lowered the Fed rate, the investment community came to understand that all bets were off. And the gold price absolutely soared. To put this in perspective for your audience in Europe, particularly your young audience, in the period 1970 to 1975, after the US legalized gold ownership, the gold price in US dollar terms advanced from $35 to $200. Quite a nice move. With the raising of US interest rates in 1975, the gold price collapsed from $200 to $100. After the US Fed capitulated, the gold price advanced from $100 to $850 in 6 short years. If you look at the decade, of course, the gold price advanced from $35 to $850. But it's important that people pay attention to that hiatus in 1975, because there's lessons there. The gold price this time will not have a stair step to heaven. There will be things that cause the gold price to decline, and investors who own it need to have a sense of history so that they don't get shaken out. It's important too, Jan, to understand the why. In the period 1970 to 1980, the purchasing power of the US dollar for US dollar priced goods and services fell by over 75%. That's what inflation did. And the consequence of that deterioration of the purchasing power of the US dollar is, I suspect, the major determinant for the gold price in US dollars. I suspect over the next 10 years that past is prologue. In other words, it won't mirror the 1970s, but I suspect it will resemble the 1970s. I believe that inflation is much higher now than most people suspect. The gauge of inflation that is widely believed by the US public to be the appropriate gauge is the Consumer Price Index, or the CPI. And if you pay attention to the CPI, you will believe that aggregate inflation is 2.6%. Inflation, including core inflation, is 2.9%. I think those numbers are very low. I think them low for a couple of reasons. In the first instance, core inflation doesn't include food or fuel. I like to eat. Yeah. So any index, Jan, that doesn't include lunch has no interest to me. Probably more importantly, as a cost of living index, inflation, the CPI doesn't include tax. Government is 36% of the United States economy. And a cost of living index, which doesn't include the largest component of one's cost of living, is, I think, fairly silly. Your listeners should look at their own experience with inflation. They should calculate as best they can easily whether the basket of goods and services that they consume has increased in price in the period 2020 to 2025. If you're German, what has happened to your power bill? What has happened to your gasoline? What has happened to your groceries? What has happened to your taxes? What has happened to your rents? Or if you own a home, what has happened to your mortgage rate? I would suggest that for the basket of goods and services that I personally consume, that the deterioration in US dollar purchasing power in the period 2020 to 2025 has been between 7.5% and 8%. Now, this is problematic on two fronts. The first is that people who are on a fixed income or people who are living on savings are seeing their living standards decline much more rapidly than they had anticipated. A bigger problem, perhaps, comes from those people whose savings are in US dollar denominated savings instruments. As an example, let's examine the US 10-year Treasury. That instrument right now is paying you about 4.5%. If you believe that inflation is 2.6%, you're getting a positive yield, almost 2% positive yield, which is to say you're more than keeping up with inflation. If you believe, as I believe, that the basket of goods and services that you consume, that you live your life on, is increasing at 7.5% or 8%, then there's a very different reality taking place. You are getting paid 4.5% in a currency where your purchasing power is declining by 7.5%, which is to say you're losing 3% a year. If you own the US 10-year Treasury, the world's benchmark savings instrument, the US government is guaranteeing that they will make you 3% poorer every year for 30 years. You'll recall at the beginning of the conversation, we said that gold does well when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. What could engender more fear than the guarantee that you will lose 3% a year compounded for 10 years, which is to say at the end of that period, you will have 30% less purchasing power than you had at the beginning of the period. This is, unfortunately, a circumstance that's tailor-made for gold. I think the average German, and certainly the average American, needs to look at something else. I don't have the numbers for Germany, so you'll have to do this. But in the United States, everybody focuses on the $36 trillion that the United States owns the bondholders. Nobody focuses on the net present value of entitlement promises, the underfunding of pensions and things like that. In the United States, according to the Congressional Budget Office, not according to some cranky old libertarian named Rick Rule, but according to the Congressional Budget Office, the net present value of unfunded obligations of the US government, things like Medicare, Medicaid, Social Security, federal government pensions, military pensions, exceeds $100 trillion. So how do we fund those? Because our society, like yours, is getting older. In the United States, it's estimated that the unfunded liabilities of the US government increase by $2.5 trillion a year. And I suspect that number in Germany is worse. I don't know. That tells me that we face an ugly choice in front of us. We can either default, which is to say your generation could say to my generation, you guys funded yourself all kinds of cool programs, but there's no money, so you're not going to get paid. Or we could raise taxes really, really, really dramatically. Or we could default on the installment plan, which is to say we honor the nominal value of those obligations in either euros or dollars, but we inflate away the purchasing power. We inflate away the net present value. I think we take door C. I think in Germany and in the United States, there will be pension reform. In other words, we'll fiddle around the edges with income caps, with eligibility requirements, all those kinds of things. But I think what we'll really do is we'll inflate away the net present value of the obligations to make them serviced and nominal as opposed to real euros and dollars. And I would ask your listeners to pay attention to that. In the United States and around the world, savers are focused on the on-balance sheet debt owed to bondholders and not the off-balance sheet promises made to civilians. And that's the biggest single mistake that I see individual investors making when they look forward.